Hi, my name is John Stevenson. Welcome to the show. Today, let's talk about the 4% safe withdrawal rate and how annuities can beat that. All right, so if you have a portfolio and you have an advisor telling you you need to take 4% out, and you're thinking, well, that's still kind of generous. I'd like to take maybe 2 or 3% out because the market's down and I don't want my portfolio to go down, but that's not enough income. Got $1 million here and I want to have some more income than just this, right? I thought $1 million was going to give me more. And then you start looking at annuity contracts and you realize there's a lot better options out there for contractual guaranteed income. So we're going to talk about that. I'm going to share my screen so you can see what's available. But if you want to skip this video and just go straight to my website and check out what those are paying now, just go there. It's johnstevenson.com and check out the calculators. Check out the income rider if you want the highest income. And then reach out to me if you want some help. So, all right. So going back to this, I want to show you what this would do. So I've got someone who's 60 years old. They're in Oregon. They've got $1 million and they're like, all right, my advisor's telling me that I can take out $40,000 a year safely. But if I have a few down years, the sequence of return risk is going to really hurt me. Okay. Because now all of a sudden I can't take, I can keep taking 4% out, but now I'm not taking 40 grand out a year. Now it's maybe 30 grand. Right. And if then I have another few bad years or one bad year or whatever, then I might have to change that again. And so that's kind of the dilemma when you're kind of getting this advice. And this 4% rule, by the way, has been debunked. Okay. You probably already know that, but it has been debunked. When this came out, a couple, 2-3 decades ago, it was based off of different market conditions. Things have changed a lot. And you have people who are experts who have debunked this several times. And they're saying, well, it's actually really maybe 2%. And so, 20,000 a year is not what it used to be, right? So if you're taking $20,000 a year from $1 million and you can live off of it, great. But most of us can't. So let's take a look at what an annuity contract will do in the same scenario. All right. So this person's 60 years old. They're in Oregon. They've got $1 million, and this scenario will probably be the same, very similar in any other state. So we look at this, say, all right, what's the income? Well, Symetra will pay $71,500. Meritas, $71,288 a year. Prudential, $70,950, and so on. So you got all these different options, different companies, different carriers. They're all good. I've worked with every single one of these. If you're just looking, hey, I'd like to have an A-rated company at least, then Symetra is great. They're excellent. Okay, I can look at this one and say, all right, I'm going to get $71,500 a year. So is that higher than the safe withdrawal rate of 4%? Well, we're getting what, 7.15? Pretty good. Here's the caveat. The balance runs out. Okay, you have to be okay with that. And, if you're looking for contractual income from your money, it doesn't matter. I have a lot of people that buy these and they are looking to generate income. That is what the purpose of their retirement is to generate income. It's not for legacy. If you want to if you want to leave money behind, you absolutely can. Leave your house behind, leave some stock behind. But really, you shouldn't feel like you need to leave anything behind. I've told my parents, you don't need to leave us anything. Okay. And they're not planning on leaving us anything. Okay. I've got a lot of siblings. There's 8 of us. So they're not going to leave us anything, which is fine. Okay. It's totally fine. It is nice to do, however, but I have, I argue on that saying, hey, help your kids out when you're alive versus when you're dead. That's usually when they need it the most. Anyway, so if you look at this, even with growth, okay, this will get some growth. Okay, then we'll say, all right, well, this account balance will probably last till you're 77, which means if you die before then, your beneficiaries get the death benefit. Okay, that money doesn't go to the insurance company. So you look at this and say, okay, well, I'm getting $71,000, so it's 7.15. It's way more than I would take ever if you're not going to take $71,000 out of your retirement account, and just to say, hey, it's never going to run out. It's going to be great. As long as the stock market averages 8% every year and I never have any down years, I'm going to be okay. But we know that's not true. Okay. And so that's the issue you run into when you're trying to generate high amounts of income. The only way to generate this kind of income is to have a portfolio of like $2 million. Okay. And that can be problematic for a lot of people. And so this allows you to generate income from a lower amount. It's contractual. It's guaranteed. It's designed to run out. Like the account balance is not designed to stay there. This is designed for a pension. So you're spending $1 million and you're buying a $2.5 million pension. Okay. That's exactly what this is. Now, what if you decided to buy this at 60, but you don't need income now? What does that look like? What if you wait till 65? Maybe you're thinking, I'm not going to stop working till 65. That's when Medicare starts. I'm going to take Social Security at that age. I'm going to work till I'm 65. I still got $1 million to put in. I still want some income from this, right? And I want to get more than 4%. Okay. Well, you get a lot more than 4% here. Now we're looking at what? 11%. Okay. And I'll show you how this works. So we'll go to F&G. Now F&G is giving you a guaranteed growth rate of, let me look here. They're giving you 7.2% compounded. Okay. So you go up here and that's not bad. I mean, even if you compare it to the stock market, that's not bad. That's guaranteed every year. So what if you have 10% in the stock market every year except one? Okay. And that's a big down year. That might drag your overall average return during this 5 years way below 7%. So you look at this and say, all right, well, my benefit base, not the account value. The account value is not going to do much growth. See, it's not a growth account. But still, benefit base, yeah, $1.4 million. They're going to multiply that by a 7.7% withdrawal rate. Okay, still higher than the 4% say withdrawal rate, and that's generate $110,000 per year guaranteed for the rest of your life. See, forever. Okay, that's pretty good. You just generated a $3.4 million pension. Now, over here, you see enhanced lifetime withdrawal. This is just LTC benefits. It's not available for very long, but it is there just in case you're confined and you need the income. But it only lasts for as long as the account balance lasts. So it's a liquidation benefit. So, but I wanted to make sure you are aware of that. Some of these companies will have that, but it's not a long-term care policy. It does not give that to you forever. But you are getting income and a substantial amount. And so if you take that $1 million and just left it in cash because you're worried about sequence of returns risk over the next 5 years, you're like, I don't want to be in the stock market and lose it, right? I'm trying to get as much as I can from it, but what if I have one bad year? Then I'm down below where I started. So you might want to just stick that $1 million in some safety, some cash or high yield savings or something, earning you a little bit. But at the same time, it's not going to generate. If you wait till you're 65, you're going to still get $71,000 a year. Okay. You might as well put it into an annuity that has guaranteed growth over here for the benefit base that will give you, that 11%. Basically, if you were to keep that $1 million and you want 11% at 65, you're not going to get 11%. You're going to get, 7.15 like we looked at. But this, because you let the benefit base grow by 7.2%, gives you a high amount of income. And the withdrawal rate is like almost double just based off of this. If we don't even look at the $1 million, we just base it off of the benefit base at 1.4 million. It's still almost double the safe withdrawal rate. And so that's how you use an annuity to beat that 4% safe withdrawal rate. You have contractual income guaranteed for the rest of your life. And if you want the rest of your portfolio to grow in the stock market, you can. Okay. And I always tell people, if you have the appetite for it, invest in other things so that you can have more growth. Because you have your annuity contract taking care of you. Maybe you have Social Security on top of this. That's kind of nice. So maybe it's $150,000, after Social Security. That's nice. That's really nice. Okay, and you can let the rest of your money grow, and then maybe every 5 to 10 years buy more contracts. I have clients that do this all the time. They'll just stack their income. So there's just a lot you can do with this. But I wanted to make sure you are aware of this strategy because it's a great way to have a much higher than the normal safe withdrawal rate that everyone's saying, 4%, which we know does not work when the market is down. That will not work. So, but this does. Okay. This is guaranteed. This is contractual. So anyways, that's all I have to say about that, but I just want to show you what's available. And as you can see, I have access to all the carriers. I'm looking at all of them here. Okay. This is just the first page. If you want to see everything, go to my website, johnstevenson.com, go to the income rider and check out what the carriers are paying. Now, you might have a few that pop up even higher than this, but keep in mind those are accelerated riders, which means they give you more income like in the go-go years, like maybe 5 to 10 years out, but then they reduce it like 40% after that. So you have to be aware of that. But the rest of these, you can see they're guaranteed. They never reduce, which is what you buy it for. You buy it for highest lifetime income. You want to make sure that income never goes down. And as you can see here, it never does. So that's what I would recommend. Go to my website, check it out. And then if you're comfortable and you want help buying an annuity, I'd love to help you. Book a call there with me. There's a link there. There's a link below this video as well. But if you like the video itself, make sure you like, subscribe, share, comment below if you have comments or questions. I'd love to help. And thank you so much for watching. I appreciate you, and we'll see you next time.